Good morning, everyone. Welcome to Phillip Securities Research Morning Call for 8th of July 2024. For today, we have an update on US software sector as well as technical analysis and a recap of our Singapore equity strategy that was held last Saturday. So let us start with the US software. So last week, we had released a report on the US software earnings results for the first quarter of 2024. And we basically have divided the companies based on their functions into four categories. So overall, software sector revenue, it grew by about 13% year over year. And this was mainly led by Microsoft's 17% year over year growth rate, which was mainly fueled by its cloud platform Azure, which grew by about 31% year over year, and continued demand for its Office 365 productivity software. So we expect the similar demand trends for its Azure platform, and for the June ended quarter, it should grow by 31% as well. And the in terms of capital expenditures for Microsoft, it grew by about 66% year over year, mainly because it invested into its data center and AI infrastructure. And despite this, it witnessed its operating margin expansion by 3 percentage points. And we expect this to continue mainly because in the near term, it will continue to invest into its infrastructure build out. And whereas for Adobe, the revenue growth rate for Adobe, it has remained constant at about 10% year over year over the last 7 to 8 quarters. And this is mainly because of its continued demand for its creative applications like photo editing applications like Photoshop, and its document management solutions like Acrobat PDF and its e-signature capabilities. However, there is no significant contribution from its generative AI tool, which is Firefly, like which basically helps users to generate images via text-based prompts, mainly because of it is facing increased competition from Canva as well as OpenAI's Tally. And we are yet to see mainly because any contribution, mainly because the company is focusing on increasing its user engagement instead of monetization. Whereas Zoom's revenue, it has been consistently declining, and for the most recent quarter, in the June ended quarter, it expects revenue to grow by just about 1%, and this is mainly because of return to office initiatives as well as in-person meetings. Whereas moving on to the CRM segment, the two companies, Salesforce and HubSpot. So these two companies, they basically provide a holistic view of the customer information, and they enable the companies to to enhance their customer relationships and to boost their sales operations. So for both of these companies, the company has guided for a significant drop in their revenue growth rate for the June ended quarter, and this is mainly because of macro headwinds. So for Salesforce, it expects a revenue growth rate of about 7.5%, which is the lowest in the company's history. And the management highlighted that it's witnessing a deal size compression as well as elongated sales cycle, and maybe because of the shift of investments towards AI instead of CRM spending. So moving on to the next category, which is ERP. So the two players are Oracle and SAP, and both of these companies, they are witnessing witnessing a weakness in their on-premise license and software sales. This is mainly because the ERP applications, they are installed on a local computer or a local server, and they can be accessed only via that. And as a result, the on-premise sales have been declining for both these companies, whereas it's witnessing a upward shift in its cloud revenues, mainly because companies, they now migrate their ERP solutions like for accounts receivables or payables or inventory management ERP systems towards cloud-based solutions like Oracle's Fusion Cloud. So mainly because of flexibility as well as global reach and enhanced security capabilities. So Oracle and SAP, they both witnessed a cloud revenue growth of about 20%, and SAP has witnessed a growth of 24%. And we expect this trend to continue as enterprises, they shift their workloads towards clouds. And moving on to the cybersecurity segment, companies like CrowdStrike, they are witnessing a robust growth for its products, mainly because like in the June ended quarter, it expects revenue growth rate of about 31%. And this is mainly because of the strong demand for its solutions like threat detection as well as endpoint device protections like prevention of mobile phones or laptops from the online threats, and it's witnessing a robust demand for its products. Whereas for Palo Alto Networks, it's witnessing a slowdown in its revenue growth rate from about 15% to about 10.5% in the most recent quarter. And we believe that this is mainly because a bit of macro headwinds as well as there is a shift in business strategy for Palo Alto Networks. So it basically provides solutions like a cloud-based security as well as endpoint protection and network protection as well. So it's basically right now consolidating its all three products onto a unified platform and consolidating customers. So they don't have to rely on other companies, and by providing by a shift in the strategy, they are providing its services for free of cost for a period of 1 month. And we believe that in the near term, this is being impacted in its top line growth. So overall, for the software sector for the June ended quarter, we expect slight modest deceleration in its revenue growth of about 12% year over year. And we like companies like ERP companies like Oracle and Microsoft, mainly because of increased cloud-based spending on infrastructure as well as workloads shifting from on-premise to the cloud. So that's all for me. Would now like to pass it on to Zain for technical analysis.
Thanks, Ambrish. Good morning, everyone. I'll move on to the technicals. So next slide, please. Okay, thanks. Okay, so let's take a look first up at the S&P 500. Last week, we saw a breakout of the range consolidation on Thursday. So for this week, I think we are likely to see this uptrend continue to test the uptrend channel resistance, which is around 5,600 to 5,640 area, with the immediate support at 5,500 to 5,540 area. Next slide, please. For individual counters, we have a technical buy on Singapore Airlines at $6.90. Take profit levels at $7.10 and $7.30 respectively, with a stop loss at $6.77. The stock last closed at $6.98 on Friday. So looking at SIA's chart, there was a breakout of a consolidation wedge recently, highlighted in blue. This was following the price actually breaking above the $6.58 range consolidation back in May. So we do see a continuation of this bullish reversal trend, accompanied with bullish momentum and a fresh bullish crossover in MACD. So the stock could go up towards $7.10 first, which was a resistance level back in February, before heading higher towards $7.30 to fill a price gap, which was formed back in February. Next slide. So this is just a summary of the trade initiated. Currently, it's up about 1.1%. So that's all from me now. I'll hand over time to Paul to give us a summary of our third quarter Singapore equity strategy. Thanks.
Yeah, thanks, Zain. So as customary, we usually give a summary of following our SSP or stock strategy and stock picks. So apologies for those who already attended the full version, but this is just what we usually do. So our strategy for third quarter is essentially what we think is that interest rates have peaked. The timing of the rate cuts could shift maybe 1 or 2 months, but essentially it's peaked, and our view is that investors should start seizing or at least capturing some of the high-yielding dividend names. Some of the REITs are paying like 8 or even 9% dividend yield. So that's the reason for the picture you see on the left here. Next slide. We'll move on to the macro drivers. Next slide. So our first macro driver is we think the US is still slowing down. the two biggest components of the US economy now is the US government. So almost 70-80% of the growth will be coming from US government. So if you look at the deficit, the US government deficit is about 6%, versus their GDP growth probably about 7% or less. So almost all the growth is coming from US government. The table here basically shows the deficit spending on a 12-month rolling basis. The big spike you see in 2020, 2021 is because of the pandemic measures. Then it resurrected again in 2023, the deficit, but you can see right now it's sliding quite fast back down to 2019 levels. So this rate of change is also going to slow down because it basically reflects the amount of GDP the government is injecting into the economy, so that the growth is slowing down. Next slide. So next is consumer. Like 3/4 of the economy is consumer. So for the US, you get the consumer right, then you essentially get it, have a sense of the whole US economy. So that is slowing down. What we do see is discretionary spending that's slowing down. There are many indicators, but we just pick auto sales because it's the easiest to understand. So the chart here just shows the auto sales. Again, is also sliding down, and could even enter into a contraction mode. Next slide. The next theme for us that we still think there's going to be one rate cut, in line with what the Federal Reserve is projecting. So you look at this table, basically the red line is the inflation rate, which the Fed gauges. Their target is the green line. So what we do see is that inflation right now is below their 2.8% target by December. And the Fed is very patient. They don't need the inflation, the red line, to actually touch 2% before they cut rates. They are looking at only inflation only reaching 2% by 2026. So from here to then, they're still looking at 5 rate cuts. The blue line that you see here is housing inflation, because that is the largest component of the inflation, and that is also starting to drift down. So these are very long periods of the cycle. When it declines for a long period. Likewise, when it accelerates. So it's still on a declining trend. Of course, the pace might slow down. Next slide. Then the next is that for Singapore, we think the exports is rebounding, because Singapore GDP is very reliant on exports. I think maybe 3-4% of GDP is exports, but it's not robust. You can see the line here. Total exports is actually coming down, but that's very volatile because of pharma and chemicals. But you look at electronics, is starting to recover. But again, this is a recovery, the red line, compared to a massive decline last year. So it's recovering, but it's not robust. And that's our key message. Next slide. Then if you want to get a sense of the domestic economy for retail sales, pardon the typo here, but it's growing at around 2% pace right now. But that includes GST of 1%. So you remove that, the Singapore retail sales is probably around 1%. This is similar to what was the average in pre-pandemic. So retail sales in Singapore was never strong. You look at the chart here, 2019, the blue line, the red line, apologies. The blue line is supermarket sales. So that's actually improving. Next slide. Gen 1, last one on macro. If you look at Singapore valuations, it's actually trading at the decade lows, about maybe 11 times off the low. Maybe the low was about 10 times. Even so, the chart here just shows the forward PE of the Singapore equity market. Average is in blue, so we are at the bottom quartile, and statistically, of course, it should revert back to mean. Not saying that it will, but hopefully it does. Next slide. But then on the politics part, the last macro theme, the view is very obvious now that Trump has a very clear lead based on this is betting averages. So these are not polls where I know it can be different, but where it's a bit more sentiment driven. This is actual bets that the market is making. So what we do see is that Trump is leading very clearly, and the focus now on the impact to the stock market will be on the battle for Congress. So if it's an all Republican Congress and the president, then it could hit the bond market, at least temporarily, because that was what happened the last time Trump came to power. The bond yields actually will rise. But the stock market might rally because there could be unfunded tax cuts. But again, as we get closer to then we will try to try to kind of provide a better narrative, because it's still unknown right now, because maybe Kamala might come into the race. But at the same time, what we think, our guess is that by maybe September, October, there could be a bit of a risk-off move as we enter into the elections, because because they could, whoever comes into power, there could be changes in the government policy. Next slide. Move on to the investment team. So our first investment team, next slide, is a high dividend yield. I hand it over to Glenn.
Yeah, thanks, Paul. Yeah, so just do a quick one on the banks. So we have basically three themes that we're looking at for the banks, and like what we expect for the second half. I think there was also a question in the chat, so this will be the answer to that. What is the outlook for the second half of the year for the banks? So this is what we're looking at for the second half of the year for the banks. Firstly, basically three things that will help the banks continue to pay high dividends and to keep up their earnings growth as well. So the first one we're looking at would be their net interest income and net interest margins. So this is actually the biggest contributor to the banks, but we're looking at it to stabilize for the rest of the year. And why is this so? If you look at this orange line here, that is the Singapore interest rates, or the SORA, and while the red line is the net interest margins. So net interest margin does actually tag along quite closely to how the interest rates are. Right, and with the interest rates being rather flat, we can also see that the net interest margins have been flattish as well. With expectations for a rate cut only at the later part of the year, we would assume that this interest rates will be stable, and accordingly, the net interest margins will also remain flat. And this also reflect in the net interest income, which is this blue bars here. Yeah. So for the 2024, we are looking at around only a decline of 3 basis points for the bank's net interest margins. So this will be quite stable for the banks. Now moving on to the second slide, we'll be looking at what will actually be the growth drivers for the banks, and that would be the loans growth. Loans has picked back up quite well, into a positive finally after the last 16 months of negative loans growth. And we saw a slight increase, a low single-digit increase in the loans. So if you look back all the way to let's say in January, at the end of 2022, right, we can see that this orange line here shows the year-on-year growth, and we saw this continuous decline all the way for almost more than a year. I think a year and a few months. Right? Why is this so? There's two reasons. Firstly, the first reason is, of course, the high interest rates. So people will consumers as well as SMEs and companies were not picking up or not taking up as much loans as they would have because of the high interest rates. And secondly, due to the high interest rates, their loans were now paying almost maybe double the interest as they were previously, right, during COVID. So what happened was that they started to repay their loans with any extra cash that they had. Hence, it was more of a double whammy sort of effect, where they were not taking out loans and they were also repaying down their loans that they have. Hence, we saw this decline in loans growth, continuous decline for the last around 16 months. So what has happened now is that, I guess the investors as well as the companies are getting more used to this high interest rate environment. And also, they need to take out loans to grow. Hence, we are finally seeing a big back up in loans growth. And with the interest rates, looking to sort of decline in the later part of the year, I think this will only be positive news for the bank's loans, and it could also further grow their net interest income. I think we're looking at around low to mid-single digit loans growth for full year 2024. So that's one of the factors that will help the banks continue their earnings. The last factor would be the fee income. The next slide, please. Thank you. Yeah, so fee income will be the main growth driver for the banks. Let me explain this chart. Firstly, the orange line is the fee income. So that's the line item that we see in their P&L. And then the blue bar here is the assets under management. So this is the AUM. So this is the base that the banks have to work on to get fee income, right? So for AUM, we have seen it growing since the end of 2020. But what we have not seen is that we have not seen the fee income actually growing in tandem with the AUM. So what you might ask, why is that the case? And that's mainly because a lot of this AUM, which is basically customers' funds, right? it's going into lower yielding products for the banks, such as fixed deposits, right? Because, you know, in that year or so ago, fixed deposits were having really high interest because due to the high interest rate environment. But then these products are not as lucrative for the banks because they don't earn as much from them. So however, we are starting to see a shift in this investor sentiment where they are moving it away from fixed deposit or current account products and going back into, you know, higher yielding products and having more of a risk on sentiment because the fixed deposits are now not earning as much. Hence, we are seeing this continuous growth we have seen for the fee income, where the banks are finally starting to earn slightly more from their very high AUM that they have. And we also expect this to continue because the interest rates are not expected to go up. Fixed deposits interest have also not increased much recently. Hence, you know, the investors are starting to get more risk on sentiment and they're moving even more funds away, you know, from fixed deposits as they start to mature and the tenor expires into higher yielding investment products. So we do expect a double-digit growth for fee income, and this will be the main growth driver for the bank's earnings for the rest of the year. Now, going on to our stock picks. For the banks, we have two. The first one being DBS. Yep, for the next slide, please. Thanks. Yep, so for DBS, why we like DBS compared to the other two banks is that they have the highest dividend payout ratio. So DBS, they actually do not have a cap on their dividend payout ratio. Unlike the other two banks, they have strictly stated that they're only looking at 50% dividend payout ratio. But for DBS, they said we're not going to do that, and they're going to return more capital to the shareholders. And you know, they also have a very clear dividend growth guidance, right? They said during their investor day that they're going to give 24 cents per year growth for dividends. And they have reiterated that this will continue into 2024 and 2025. However, you know, one of the good things about the positives for DBS is that they actually said that that's the base and they've made it higher than it was. So they pushed up this supposed guidance for dividend growth and also gave more in the form of a 1-for-10 bonus share issue. So we are looking at DBS to continue to grow their dividends and give back more, even as their earnings also increase. So we do have an accumulate call with a target price of $38.50, and we're also expecting a dividend yield of 5.7% for DBS. Now moving on to the next one, our next pick will be OCBC. Yeah, so for OCBC, what makes them stand out from the other two banks is that they have the highest CET1 ratio. So a bit of explanation on what CET1 is. That is their highest quality of capital, and also it shows how much they have to either make acquisitions or to give higher dividends to return it back to shareholders. Right, and the optimal CET1 for a bank, for a Singapore bank at least, is around 13.5 to 14%. So OCBC's current CET1 as of first quarter is at 16.2%. It's significantly higher than DBS at 14.7% and UOB at 13.9%. And even if what they're trying to do is they're trying to spend their excess capital, and they have done that, and they're trying to do that by acquiring the rest of Great Eastern that they do not own. So even if that happens, right, they will only go down by 0.6 percentage points to 15.6, and that is still quite a bit higher than their peers. So even if they were to lower it to match DBS's 14.7%, right, that's around, they can afford to increase their dividends by 50%. So there is some upside and some upside surprise to the DBS or OCBC's dividend yield. And you know, we could possibly expect some increase in dividends, even if they don't return fully, reduce it fully. So we do have an accumulate call on OCBC with a target price of $15.40 and also an expected dividend yield of 5.7%. So for just to add it in here, for UOB, we do have a target price of $34.90 as well as a buy call. Yeah, so that's all I have for the banks. I'll now hand it over to Darren for the REITs. Thank you.
Thanks, Glenn. Yeah, so for the REITs, we are overweight REIT. So for dividend yield perspective, right now forward dividend yield it looks attractive. It's about 6.5%. So now it's trading at about almost 1x standard deviations above the 10-year mean. So that's mainly because of the share price action. Yeah, the share price really corrected in the first half of this year. So as a result, the yield is higher. and it's not the higher yield is not so much attributable to the fact that the DPU has been increasing because of the cost interest rates still remain very high. Yeah, next slide, please. Yeah, so this is the finance cost for the four largest REITs in Singapore listed that is inside the STI component. So from 2022 until 2023, we see the interest rates increase, or rather the finance costs also increase as a result. And the 2024 and 2025 estimates are actually the analyst forecast, consensus forecast for the excuse me. The 2024 and 2025 are the analyst consensus forecast for finance costs. So analysts are expecting that finance costs will peak 2024 and 2025 as the loans are repriced, and the finance costs will come down in 2026. So as a result, we are expecting the DPU to kind of significantly improve in 2026 as interest rates start to come down, and as a result, finance costs will come down as well. So interest rates, we're expecting perhaps 3 cuts next year and 1 cut in 2024. So as the REITs reprice their loans 2025 or 2026, then you'll see the impact of the lower interest rates and improve finance costs. But for now, these 2 years, 2024 and 2025, interest rates still remain high, and we still expect finance costs to remain high as well. So not much DPU growth for this year and next year. Next slide, please. Next slide, please. Yeah, so for stock counters, we have first of all, we have Cromwell European REIT. So Cromwell is a European logistics and office REIT. So you can see the orange line, that is the occupancy. Occupancy remains really stable. Now it's 94%, so it's very high. And this is compared to a lot of the other REITs overseas, REITs with overseas assets, where if you compare to the US REITs, like the office sector REITs, they only have about 80% occupancy. So this 94 is really stable. And on a DPU perspective, we forecast it to drop in 2024, or this year rather. That's mainly because Cromwell is divesting a lot of assets to keep their gearing within the comfortable levels, 35% and 40%. So right now, gearing is around 40%. And as a result of that, that when they divest assets, there will be absence of contribution of income. So that's also why there's a drop in DPU as well as higher interest rates. But for interest rate front, since the ECB has already cut rate once and perhaps another cut, more cuts to come this year and perhaps next year, we're expecting the DPU to increase next year, especially since the lower interest rates will start to kick in. And despite this, at 13.76 euro cents, Cromwell is paying 10% dividend yield despite the decline to 13.76 euro cents. So that's why we think Cromwell is attractive. Is paying close to 10% dividend yield at this price. Yeah, next slide, please. Yeah, so next we have First REIT. So we recently initiated First REIT. First REIT basically is a healthcare REIT with assets in Indonesia, Japan, and Singapore. So 75% of the portfolio is in Indonesia, about 15% or 20% is in Japan, and Singapore is the remaining 5%. So from the rental contribution side, Indonesia accounts for more than 80% of rents. So as you can see in this red box here that we've highlighted, Indonesia's assets are really stable because it's under a 15-year master lease for the hospitals. So basically every year they have a 4.5% rental escalation from 2021 all the way to 2035. So that is the base case. And if let's say the hospitals perform well, then they'll be getting the performance-based rent, which is 8% of the hospital's preceding year's gross operating revenue. So currently there are already 3 hospitals that are paying this performance-based rent. And the catch for this new restructured lease was that previously it was in Sing dollar, but now it's in Indonesia. Now it's paid in Indonesian rupiah. So basically, First REIT is exposed to the Indonesian rupiah. They do try to hedge about half of the rupiah, but it's expensive because of the continuous depreciation of the rupiah against the Sing dollar. So right now it's currently about 1/3 of the revenue hit. 1/3 of the revenue is hedged. Yeah, so basically we like First REIT because of the income visibility from the Indonesia side. And this 4.5% escalation will help to kind of offset the depreciation in the rupiah. And also before the master lease restructuring, they were heavily reliant on Lippo Karawaci and to pay the rents, as they contributed about 88% of their total rental income. But since the restructured MLA, they have added, firstly has added Siloam, which is the hospital operator, into the master lease agreement. And over time, Siloam will start to contribute more revenue until in 2026 is expected to hit about contribute 80% of the revenue from Indonesia. So the thing is that first, Lippo is a property developer where they are experiencing some tight cash flow, while Siloam is a cash cow. Basically, their revenue keeps increasing because of the improvement in operating performance, and they are very cash rich heavy for Siloam. Next slide, please. So as a result of FX headwinds and FX losses, we also forecast DPU to drop this year, but recover next year as more rental escalation kicks in and more hospitals, probably one or two more, enter the performance-based rent. So even at 2.36 Singapore cents, First Street is paying a good yield of 9.6%. Next slide, please. And for the last REIT for me is CapitaLand Escort Trust. Despite basically like CapitaLand Escort Trust because they have 300 million of divestment gains that are yet to be paid out. So this can be used to top up DPU as and when. And like there's some properties that are going to undergo some renovations and refurbishment, so that will cause some loss of income. And Escort will plan to use some of this 300 million divestment gains to top that up. And 300 million in divestment, 300 million of divestment gains sitting in the books is actually more than one whole year's distributable income as well. So it's quite significant. And this is despite the fact that first CapitaLand Escort Trust operating performance continues to improve, especially with the Olympics and the Taylor Swift World Tour benefiting them in a lot of different countries. And so this chart here is basically just their good history of divesting assets at a premium to the book value. So they've been getting good divestment gains over the course of the few years. Like you see 19%, and especially the one in February, the divestment of the Somerset Shanghai, they divested at 171% premium to book value. And their current Escort is now paying a 7% yield. So that's all for me. And Escort, I'll pass to Mel. Thanks.
Thank you, Darren. So we initiated OOE rate last month. We like OOE rate mainly because of three reasons. First is because of its attractive valuation. So OOE obtained investment grade rates from S&P in 2023. Here's a table shows a few metrics of OOE rate compared to other investment grade rates. So they have relatively healthy gearing of 38.8%, and it's also trading at more than 50% discount to its net asset value, and very attractive dividend yield of 7.8%, which is higher than the average of 7.8%. And secondly, we like OOE because we believe the upside will be mainly coming from the hotel sector. So they are well positioned to capture the momentum of influx of event-driven tourism. Hilton has just rebranded to Mandarin Orchard rebranded to Hilton in FY23 and had its full contribution last year. It changes focus to more of the corporate travelers. So as a result, post rebranding, RevPAR increased by 27%. And we focus another 11% year-on-year increment in terms of RevPAR, as there's like muted supply in the mid-tier hotel segment, and also recovery of international visitors' arrival. And at the meantime, downside will be protected by the master lease agreement. So this would generate around like 6% dividend yield. And last but not least, 70% of the revenue is usually generated from the office and retail sector. And OOE rate managed to secure a rental reversion of 12% and 13% for office and retail in FY23. We forecast rental reversion to maintain its momentum and landed to at around 10% this year. However, we do expect DPU to drop marginally in FY24, given the increasing financing cost. Yeah, but again, we forecast stabilization from FY25 onwards. Yeah, next slide, please. So, second theme is earnings growth. And yeah, we have China Aviation Oil, CAO. So profit for CAO are mainly coming from two parts. One is from its profit from associates. So CAO owns 33% of Shanghai Pudong International Airport, and they are the only jet fuel suppliers for all the international airplanes which departed into the airport. And that is the second largest airport in China. So this part of the profit accounted for around like 70% of the profit pre-pandemic. And with the recovery of international flights, so the graph shows air traffic increased by 3 times year to date. Yeah, so we anticipate profit to double this year. So we'll double from 30 million last year to 60 million in FY24. And apart from the profit from associates, CAO also supplies jet fuel globally, especially to China. And since China is one of the largest jet fuel exporter. Yeah, so with the recovery of international flights, all flights, this would support another 30% of the profit. And we also like CAO because of its very attractive valuation. They currently host 370 million cash in hand, and its market cap is around 750 million. So 50% of the market cap is made up of cash. Yeah, and they also have like pretty discounted multiples. Like the forward PE is at 7 times, with EV over EBITDA at 2.9 times. Yeah, so we believe it's heavily discounted. Next slide, please. Yeah, so we have Pan United. We like Pan United because we believe this is another way to play the construction sector. Yeah, given their 40% market share in the industry. And we're particularly optimistic about the construction industry because they are on the multi-year growth trajectory. And pre-pandemic, the annual construction awarded was around 29 billion per year. But now we are seeing a 20% increment for the next 5 years. So each year we are talking about around 35 billion contraction awarded. So this provides a very visible earning for Pan United for the next 5 years. And here's a graph shows the demand for concrete, mixed concrete. It increased by 13% in first half 24. And we believe the momentum is very sustainable for the next 5 years. And in FY24, we forecast the revenue to increase by 12%. Yeah, that's all for me. I'll hand over to Paul for oil tech. Thank you.
Yeah, thanks, Mel. So continuing with the earnings growth theme, so another stock we like that can enjoy earnings growth is Alltech. So Alltech actually they help palm oil plantation companies to build refineries, biodiesel plants. So the last 5 years, historically, the order books have grown by 50%. The order books is the most recent number is gone up to another from 361 to 430. What we do see is there are several growth drivers. Because essentially for Alltech, they're very dependent on the customer's capex. So the capex cycle underway is biodiesel in Malaysia. They will increase the mandate from 10 to at least 20. They are seeing customers building, preparing for that. Second thing is that even though Indonesia's biodiesel mandate is already hit 35% blend or B35, but they are expanding into other islands, not just the core Java. So they have getting orders for that. Overseas, they are getting customers, especially Latin America or even Africa, expanding capacity or also moving downstream further into more palm oil, refining palm oil for vitamins and so forth. The more famous are tocotrienol. So that's the other area that they're seeing growth. And the fourth one, the big one, will be sustainable aviation fuel. If they proceed to get that, because that is that order book will be, double or even triple the current levels. So for that to happen, what they are doing is that So sustainable aviation fuel oil is basically mixing around 1% blend right now to your oil to jet aeroplanes. So sustainable aviation oil is virtually cooking oil, but you can't just use cooking oil. You have to use it with palm oil. So right now, is the palm oil has the effluent, the waste oil that they're going to use it for jet fuel, something like what Nest does, NESTE. So they're going to build, looking for contracts for that. So that will be the big growth, the next big growth driver for them. As even a 1% could see capacity double or even growing almost 10 times by 2030. So that's the big opportunity for them in this region. And the business model is also strong. They have ROE at 30%. Their net cash about 132 million ringgit. And they have fixed assets of only 3 million ringgit because most of the project work they do is outsourced. They normally provide the engineering design. Right now they're doing more turnkey, so that's one of the reasons to the order books are rising. But they don't have like in-house construction and all that. Mostly all project managers and design managers. Next slide. Move on to comfort. Of course, I'm mentioning this, so everyone's probably tired of this, but we still think that this year will be another year of growth. Some of the drivers, so the picture here is basically their net cash, and then the red line is essentially the earnings growth. It'll still be another year of growth. We're going to see Singapore taxi platform fee that was introduced end of the increase in platform fee. The higher commissions, that's ending soon, but because the taxis are charging higher fares, so they will benefit indirectly. China was probably the one that was a bit more unknown, the growth driver here. So in China, what they essentially do is they are mainly a rental fleet. So they're not really operating taxis. So it's not like the comfort we see here. China is mainly rental. So they'll just rent out cars to drivers who might probably use Didi, the so-called Grab equivalent. Because over there to do ride hailing, you need a taxi license. So their fleet used to be 11,000, then it went down to 9, now it's growing back to 11,000. Because of the pandemic, a lot of drivers left and gave back the cars. So you can see growth. UK recontracting, because every 5 years, they are recontracting from very low margins to better margins. But you come with a lag, of course. And acquisition growth, they make a few acquisitions and the growth will come in mainly on the third quarter because some of them will be seasonally impacted. The negatives is the Australia poorer margins because they recontracted for lower margins and flat Singapore real. The earnings continue to be, I think, sub 5 million or less. Even though it's supposed to be running an MRT, mainly because of the high utility cost, it takes time for them to pass it on because they have to wait every year, end of the year before the authorities revise higher the prices or the fare. Sorry, next slide. Move on to on the growth team. We think semiconductors will be the other growth team. So what you see on the table here is basically foundry capex. So foundries are like your TSMC, UMC, Intel, Samsung. They are foundries, or even Micron and Hynix. So based on their capex, your companies like Franken and so forth, they supply equipment to these companies. They are supplier. They're not really the equipment makers. So when their customer's customer, so their customer, let's say it could be Applied, then Applied's customer is all these foundries. So that is growing. You're going to see the big rebound in 2025. The one we're watching for is as the title suggests, whether AI spreads. The one we're not sure. So AI spreading means AI will not just be in the cloud because most of the NVIDIA chips now in your data centers and cloud. So the key thing now is whether the AI, everybody will upgrade from the cloud or upgrade their PCs and their smartphones. If that happens, then this will be the biggest re-rating for the electronics. We don't really see it now. I mean, I myself am not going to upgrade for AI, but that's something that we're watching for. The rebound you see here is partly due to that and also mainly because of memory prices rebounding, especially the high bandwidth memories, and the memory makers are all raising up their capex more aggressively. And of course, partly due to AI, like what we see in TSMC. Next slide. The other one, we still think marine looks attractive, although we don't have a direct coverage. But this is basically the order book of Keppel and Sam Marine, or the so-called Seatrium now combined. What you see that after the recent 11 billion orders for 2 FPSOs in Brazil. The order book jumped up by 11 billion to 25. We think there is momentum in this stock still, although probably it's ultra negative, everyone, but mainly because the earnings is doing well. And if you see someone like Dynamic announce earnings, strong earnings that can drive the share price, then it could also happen for Seatrium. Although we think order books is the biggest driver for this kind of stocks, because obviously earnings is going to be good because when the order books are so high. The second thing is there's still, according to Seadrill, I mean, there's still another 11 FPSOs per year the next 2 years. So that could still improve their order books. The red line here is basically the oil proxies. So even though all capex, that means the BPs, the Shells are not really raising their all capex very strongly, like what you saw in 2013, 2014, when they had the last big run. The order books are still at high because the title ironic is that they are getting orders now not just from oil and gas but also from the renewable sectors, especially offshore wind. Next slide. So the other theme is geopolitics. Next slide. So if you're very bearish on that the lack of better world on fire, there's a lot of conflicts and so forth. The ideal thing to do is of course long treasury, long gold and short treasuries. But for equities part, for Singapore equities, we think ST Engineering is the proxy. So ST Engineering share price admittedly hasn't moved for the last 10 years. It basically went flat. In part due to the earnings is also went flat. They made like I think 300 or 500 million. The never changed the last 10 years around that level. But you can see here that the order book has started to climb more strongly, and that's one reason why the share price has recently done a bit better. And the first quarter earnings also revenue jumped by 18%, which we think with operating leverage earnings should grow outpace that, because in the first quarter update they don't really give earning numbers. But the two main drivers is defense. So of course, when conflicts are rising, there are more countries and they're exporting more. More countries are stockpiling, and also for aviation growth, the other big driver for them is aviation, which is commercial aerospace. So as more planes fly, they will need more maintenance, and that's one of the big growth drivers for them. In addition to passenger to freight conversion, because of the low inventory, a lot of the fleets are getting old, so there's also another growth from passenger to freight conversion. Next slide. And if you're still interested to play geopolitics, would be of course shipping. One of the reasons, this is the container rates. I think we've shown this before, but container rates, the red one, the blue is basically from China to US or Shanghai to LA, and the red one is from China to Europe. But what you notice is that the rates have spiked back up from 2,000 to 6,000 per US dollar per 40-foot container box. This is like a tripling year on year. Month on month also up, so that's what's probably helping to drive Yang Zhejiang, because of it also implies maybe another ordering cycle. But we're a bit more cautious on this because this Gaza conflict, you're making a bet that this thing could extend for a few more months. But anytime that if you get a peace deal, and just worried that this charge could actually come down quite sharply. So that's the risk that everyone's taking if you're playing on this so-called Red Sea conflict-driven rally. Next slide. The last theme we have is second last, sorry, is value. So no pun intended, Valuetronics. So we still like it. It's still very cheap. It's only 2 times EV/EBITDA or 2 times cash flow, and 80% of the market is in cash. They have a cash holding of about 200 million Sing dollars of cash. The market cap is probably 200 plus, if I'm not mistaken, right now. The chart you see here is basically their net cash versus the market cap. We think there's going to be growth, stronger growth in the coming FY25. They're also buying back shares. I think another 60 million of shares that they're looking to buy. And they're paying almost 6% dividend here, so that's why we consider it like a value play. You're looking for a value team. Next slide. I will hand over next to Darren on some of the value names.
Yeah, so for the next value name, we have CDL. So CDL right now, they're trading at more than 60% discount to our INAV and about 50% discount to its book value. So we take a look at this chart, we see the property sales numbers have dropped since the ABSE hike in 2023, April. So in 2023, we saw only 730 units sold. So that's like about 50% drop on 2022. And and there's a further drop from 2021 numbers. So property development will remain weak going forward until there's a change in probably this ABSD 60% for foreigners. So that really hurt them, especially since CDL still has Newport Residences. It's one of their higher end developments or projects. It's a freehold property that's in the core central region. So yeah, because of that, it's been pushed back and it's not been launched yet. So yeah, that the property development side still remains a headwind for city development, even though the hospitality has been it has been improving. But one more thing to note is that other than the fact that the number of units sold is at 5-year lows, the share price is also is more than 5 years, it's 15-year low share price. So the last time the share price was lower than $5 was in 2009. So that's a GFC. But since then, right now the share price is at $5.30. That's the lowest it's been since then. Yeah. So next slide please. So for any recovery, we believe we need to see a catalyst, or there needs to be a catalyst. It could be more interest rate cuts, so that could help with mortgage rates, or yeah, maybe some government some new rulings in the property development sector. Yeah, so that has been some sort of catalyst for that. And we also want to highlight that for price to book ratio wise, right now CDL is about 0.5 times, but take a look at Hong Kong land. Hong Kong land 10 years ago it was at 0.5 times price to book, and investors may think that 0.5 times price to book is cheap, is a value play. But we look what happened to the price to book 10 years later, which is now the price to book from 0.5 times cheap until now 0.2 times still cheap. So yeah, it's basically we don't know when the bottom will be. So it's hard to call a bottom. Yeah, so that's our take. But we still believe there needs to be a catalyst for the share price to really move or recover. Yeah, I'll hand back to you, Paul. Thanks.
Okay, thanks, Darren. We'll move on to some of the re-rating names. Next talk. So like we highlighted, Keppel could have been another those value names, probably keep on trading down in price to book, but because they were recycling or at least monetizing some of their book value. So we still think there could be one more move on Keppel. It's essentially more of an event-driven stock rather than operationally, because I don't think operation is that exciting. Some of the events that or catalysts we are looking at is their notes receivable. So these are the rigs that they sold and they vendor finance. Basically, when they sold these rigs, they collected these notes. Although no payment has been made, but if once the company sells the rigs, then they will get this big one sum payoff. The other thing is because rig prices continue to climb, so there should be optimism that the company that owns these rigs can sell it. This particular fund. They're also looking to dispose of some of the assets they have, the real estate property in China, Vietnam, data centers in Singapore. I think one data center in Singapore at least. And of course, the M1 consolidation. The other trigger, this one, again, more longer term, don't hold your breath, this 2030. So I don't think this can move the share price that much, but it's just one of the items, unless they hit their target much earlier, because 200 billion is a huge number. So this stock will be more of a event driven rather than any particular operationally strong growth. Next slide. For Singapore, the story a bit better because you're going to get operational growth. So the first theme is the lower cost, as the title shows. So we think that lower cost comes from the cost cutting. So after many years and after Singtel, Optus only having 1% kind of ROA, they started to cut costs at Optus. I think the most recent results, we saw the headcount come down by almost 12%. So it's quite an aggressive move because they have target to cut costs by 200 million Sing dollars per year for the next 3 years. So this will be one trigger for the re-rating. The next is higher price. So this is mobile pricing. They guided 1.1 billion, but with Bharti now raising prices recently, I think this should be another potential catalyst driver to the share price. The next is asset disposal. So they earmark 6 billion of assets to dispose. I think some of this could be some of the associates that they have, because if you do a valuation of Singtel together with the listed mark to market, this stock is like 4 something, but of course all the analysts just give discount, like price to book, right? You can have cheap valuation, but if you don't sell anything, then it's more like paper money rather than anything that can be realized. Or paper value, sorry. Then the last one here, this one is a bit less of a known. This is more like a guess. We haven't put in a number, but NVIDIA as a service is also another potential re-rating, although they never give guidance. Because if you do some back envelope based on the 100 megawatts that they have, you put in like maybe $3 to $4 per megawatt, 40-50% EBITDA, you're looking at almost a contribution of 300 million. But again, these are all back envelopes, but we just put it out there because one thing is that many countries are now sovereign AI. So there's a lot of countries now doing GPU as a service. So won't be surprised if Singapore, as a country standalone, also have their own GPU as a service. And they probably won't do it with a foreign country. Yeah. Next slide. So this is just our last portion. We just run through the model portfolio. So the model portfolio was basic for the last 3 months. It's basically flat. Ignore this because it actually was, I think, down 0.3%. Because OUE, if you put in Thai BEV, we were down about 11% for the 3 months. So consumer Thai BEV and actually Capital was the one that hurt the performance. The one that helped us was the banks and Singtel, I guess, and also Valuetronics. Yeah. Next slide. Okay, with that, I'll go on to some of the conclusions we see. We still think the US economy is slowing down. Another data point to watch is also consumer delinquency. So it's a credit card delinquency in the US. So that's another reason why the slowdown is becoming more and more evident. The US consumer is stretched, and also government spending is year on year. The growth rate is also slowing down the rate of change. But near term, all these bad news actually going to be positive for the market because, like I said, bad news only means that the more likely the Fed will cut rate until the economy is just so worrying. Then the bad news really becomes bad news. I mean, I'm not sure any other better way to explain it. But second thing is we still take the view that interest rates have peaked, and the strategy is to try and catch some of the more higher yielding names. Very few of these are actually Singapore portfolio assets, maybe apart from OUE. So most Singapore pure assets are probably trading at 5% or maybe 6%. But that's why we also took coverage on OUE because like 92% of the assets are all in Singapore, where the values are more stable and it's not creeping up. We are over 8 banks, REITs, telcos, and construction. So construction is also doing exceptionally well. Apart from the orders coming up, because second half you're going to get the T5 contract awards. So you ain't seen nothing yet. I mean, I guess like a better word. And supply in a way for construction actually has come down because we just spoke to one construction company because it used to be 1 to 7. That means one local to 7 foreign. Right now the ratio has dropped to 1 to 5. So in a way, the supply available for construction actually come off quite a bit. Yeah. Okay, thanks everyone. I think we can move on to Q&A. Thanks.
Yeah, let me just take some of the banking questions. I think there are quite a few I saw. Okay, so just let me go through. Can we assume loans growth for the banks with fourth quarter rate cut vis-a-vis impact on their NIM? Yeah, so you're right. I think it's really when you know the NIMs go up, right, due to the interest rates, the higher interest rates. You're right, the loans growth will go down, which is what we have seen. So what we're expecting is, but however, this is a very interesting scenario now for the banks, is because the NIMs is not just, so let me just explain a bit first in detail how a bank's NIM is made up of, right? Net interest margin. So you might think that, oh, net interest margins means basically the margin that they earn from their loans that they give out. So like let's say I just put it in simplified terms, like you have a housing loan, you pay 3%, right, for interest for the housing loan. Then the banks have their cost of funds, which is like their deposits or fixed deposits at like let's say 2%. So that 1% spread is how much they earn, right? So technically that's right? That's how they calculate their net interest margins. But there's another big portion for the banks, which is where they can take the customers' funds, excess funds, right, which they're not lending out, and then they put it back into higher yielding securities or government securities, or even other fixed deposits where they can actually earn a higher interest. So what these banks have done, at least as local banks have been doing and trying to do, is to take a lot of these excess deposits that they have, because now they're not lending it out because loans is rather stagnant, right? So they take it and then they park it into longer term, higher yielding securities and treasuries, right? So this can earn them higher yield, and they are also able to project in the future how high their net interest or how much their net interest margins will be, let's say, into 1 year or 2 years later. So instead of, but of course, the downside to this, when they park it into higher, longer tenures, is that the interest is not as high, right? Compared, let's say if you park it into 1 year, now you will not earn as much as if you put it into a 6-month or a 3-month. So, but however, what the upside to this is that they're able to better project and predict how much their net interest margins will be into the next year, into this year, end of this year, or even into next year. So this is what the banks are doing right now. So if the rate cuts, it might not affect the banks as much, as you would think, because yes, they're right, that the top line with the amount that they earn from their loans will not be as much. But then again, their loans is not growing as fast as well. So there's a sort of like a backup where they put their rest of their excess funds into these treasuries or securities to earn higher interest yielding. So yes, you're right, the NIMs might take a hit, which is why we are also forecasting for the NIMs to be on a side of a low single-digit decline, but loans growth will be picking back up faster than the net interest margin decline, which could also push back their earnings. Okay, next question. With so many moving parts, loans, fee income, net interest margins, etc., how will these factors ultimately have positive or negative impact on the bank's earnings target prices in the second half? We feel that it'll be a positive impact. As I mentioned earlier, right? The three main factors which you have said here. Firstly, loans will likely be positive, and we expect it to be positive. With even though the interest rates have not gone down much, or actually it has not gone down at all, but we have seen loans pick back up. So this shows that all the repayment has hopefully been done, right? Companies, it may not be a good thing, but companies, individuals have run out of excess cash to repay their loans. So that's one of the reasons why loans growth is positive, is becoming positive. And also secondly, they're getting more used to these interest rates and they need it to either to grow further or they just need the loans. Hence, we see loans growth picking back up. So that's a positive. Fee income, I've also gone into detail earlier why it is a positive, because of the large AUM or assets under management base that they have. And also now people are shifting more from low yielding products for the banks to higher yielding products like the wealth management, investment products. So this is what we are seeing and what we are expecting will continue. And lastly, I also just explained how the NIMs will be stabilized. So these factors will ultimately have a positive impact on the bank's earnings. Okay, this one is quite an interesting question. Is OCBC confirmed redeveloping the head office at Chulia, and what's the impact? I think they're doing some kind of renovation now. When the last time I went down, I did see they were doing some form of they were talking about some renovation, or the office was undergoing some refresh, right? I think this is to match their strategy of now. They changed their logo, right? And they changed their strategy. Now it's a one OCBC group. So now they're doing that takeover for Great Eastern. So I'm not sure if they have really confirmed going to go ahead with a major redevelopment, but you can see that certain small things is being done. So what's the impact? I don't think the impact will be quite small, right? They're not doing a large overhaul of the whole, tearing down the building, right? So it's really the internals that they are maybe just doing a minor renovation refresh. So I don't think there's really a big impact even if they do, unless they say they're going to tear down the building, which I'm not sure it will be done. Okay, last week, one analyst mentioned that if Great Eastern were to make a final exit offer to remaining shareholders to reflect what's fair and reasonable, those who accepted the earlier offer of $25.60 will enjoy the offer too. Or did I hear it wrong? Please comment. Right, this person has already accepted the $25.60 offer after the independent report. I have to double check on this. I've been trying to see, is to use like the Boosted case as a case study to see, what if those people that accepted the first offer, if they did get the exit offer, but I wasn't able to come to a conclusion with that. So I'll have to double check and see. But from my understanding is that it might not be able to get the exit offer price if you already accepted the first offer. But I have to double check that and I'll get back to you. So you have already accepted the offer. So maybe for those out there who are on the fence, right, of what to do, I'll just quickly go through there's a few scenarios as to what will happen now to Great Eastern shareholders, who have undecided, right, on what to do. So first scenario is, what will happen is that if they manage to get more than 90% of the unowned shares, right, OCBC. So if they do that, then there will be that's the easiest, right? They will get a compulsory acquisition because they manage to get more than 90% of the unowned shares. And then, that's just the story is done, right? They do compulsory acquisition. So the other two is the more interesting scenarios and also a bit more unknown because we're going into unknown territory. So the second scenario is what happened to Boosted, is where OCBC managed to get more than 75%, but less than 90% of the unowned shares. So in this scenario, what will happen is that they were to give an exit offer that is fair and reasonable. And fair and reasonable is, according to the IFA, it's ranging, I think it's above $28.80 something. So it will most likely come, if it reaches this scenario, most likely it will come in at around, my best guess, right, is $29 or high $28, like just below that bottom benchmark that they gave, that IFA gave. However, with this scenario, what is stopping them is that, there is there's a shareholder, I think it's the Wong family, that has around 3%. So 3% of 11%, that's already, more than 30% of the unowned shares. So they might not be able, if this party, which has openly and publicly said that they're not going to sell at the current price, don't sell it to OCBC or don't let go of the shares, then it will be very hard for them to cross this 75% mark to be able to even give an exit offer. Right, so although you have taken up the offer already, so it's highly unlikely that we will see this, because if that group doesn't let it go, then we will not cross this 75% threshold. Then it will go to the third scenario, which is they fall below 75%. So currently they already have more than 90% total shareholdings, which means that Great Eastern trading will be suspended. But whether or not it's delisted depends on different scenarios. So what will happen if they get less than 75% of unowned shares, is that SGX will probably ask them to restore the free float so that it's more than 10%, which means that it brings down their total earnings to below 90%. So in this scenario, then the worst case is that the share price will drop back down to the pre-offer price of around $18.60. Yeah, so that's the three different scenarios there. I think highly likely what will happen is either two, if they manage to convince that the larger shareholder, the largest minority shareholder, to release the shares, or three, if they don't manage to convince, then what will SGX do? Because this is really, as I reiterate again, is very unknown territory, because after SGX changed their rulings on delistings, right, we haven't seen a similar scenario happen. So we are really unsure of what will happen if it hits below that 75% mark. Yeah, hope that clarifies some questions for those Great Eastern shareholders. Okay, next question is, media reported that DBS bought 1 million units of CapitaLand India Trust. Actually, DBS could have used the excess cash for investment to further boost earnings instead of simply paying out as dividend. That's a very good question, because a lot of people are asking, like with OCBC, right, they are not paying out dividends, yet they know this Great Eastern acquisition, right? So a lot of them are asking, why don't they just give dividends, right? Because shareholders, a lot of them are long-time shareholders of the banks, and they say that finally the banks are doing very well, and their capital ratios are so high, they have a lot of excess capital to return. But if you don't return it, then the shareholders won't be happy. And I think with DBS, majority of the shareholders are actually quite satisfied that they have done both. So they have not only just returned their excess cash as dividend, right? But they also did the City Taiwan acquisition, which also took a big chunk of their excess capital and lowered it further. So I think in DBS's case, they did both. Yeah, and they are doing both, right? So we have the three different banks, and all the banks are doing different things. So DBS, they are returning excess cash, excess capital as dividends, and also did acquisitions. For UOB, they did the acquisition, but they are not returning the excess cash or capital as fast as DBS, so they're holding it on. And then with OCBC, we have the ones who actually really did not do anything. So they did not really return as much dividends, and they also did not do any main like really big different acquisitions, inorganic acquisitions, right? So now the only acquisition they are doing is the GE one. Let me see. I think I got maybe I got one or two more slides. Let me check. DBS is very close to target price, should sell or switch to another counter. As I said, DBS, they are the only ones that is aggressively giving out dividends and increasing, not just giving out, but increasing their dividends. So even at their very, their target price, that's right, their share price has shot up a bit, but their dividend yield is still the same. We're expecting it to be the same as OCBC at around 5.7%, right? At last I checked. So this, if they do surprise us and give us even more increases in the dividends, or maybe another bonus share issue, it's really hard to say, right? Then it would surpass the other banks, right? Their dividend yield. So for you to sell or switch, I think you have to make it's a bit you have to take the whatever I say, and then you make a decision. For our other pick, which is OCBC, I mentioned earlier, there is a surprise there because we're not sure what they're going to do with their excess capital and if they're going to return it. So they're both quite similar in terms of dividend yield. But with DBS, it's more or less quite a sure thing that they're going to further increase. But with OCBC, it's really more of if they're going to do it, and if they do it, hopefully they give a big one, like a large amount, and it increases because they have the buffer to do it. Yeah. Okay, there's one here. Insurance company should benefit also, right? Any to recommend, as Great Eastern will be delisted soon. If you would really want to have an insurance like a Singapore, right? If you really have Great Eastern and you want to have that in your portfolio, I would say I think OCBC is a good bet because you're not just getting a bank, you're also getting an insurance company. They really do own like 89% of Great Eastern. And even if this doesn't go through or falls through, right? They still own majority. So you're not just getting an insurance company, but you're getting a bank as well, right? With an insurance company on the side. Yeah. So my recommendation would be OCBC if you want some exposure to the insurance companies. So last one for me here is, will you recommend to sell Great Eastern in the open market now for minority shareholders? I think the best case, if you have now, it would be if you are willing or you are okay to sell it at the current price, right, which is $25.60, then that would be the better option because if they, let me double check on the last part, if they do have the exit offer, if you can actually benefit from it. But if you sell to the open market, you definitely will not be, there's no chance of benefiting from any higher offer in the future. But at least if you do accept the offer, right, you're assured that you will get it from OCBC, right, that price is locked in. And it cannot go lower, it can only be higher. So there's at least some potential upside. But if you sell it in the open market, then there's virtually no upside. It means you really sell it off and you don't have it anymore. Yeah, there's no bargaining power or anything at all if you do sell it in the open market. So if you're okay with it, with the general offer price of $25.60, then you can just accept it. Yeah. Okay, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
I'll take the sets question. What's the IFA and any updates on sets? Also, we believe sets is pretty well positioned to have a stronger 2024. So from the ground handling side, the segment is expected to be benefited from the recovery of passenger flights in Changi Airport. So the volume is near to the pre-pandemic level. Yeah, so we expect a full recovery by the end of FY24. And they are also reviewing contract with SIA And we believe there will be some like upward reversion instead in terms of the unit price. And but some downside will come from the inflationary pressure to increase the cost. Yeah, but sets are mitigating through providing like more automated solution. And for the cargo side, integration with WFS is well on track. This is reflected by the recurring EBITDA, it increased by like 40 million per year. Yeah, so this progress is very ahead of their goal of generating 100 million in additional EBITDA within 3 to 5 years after the integration. And additionally, SES also like saved 65 million of the interest of the financing cost. They used to have like pretty high cost of debt, around 8%. Yeah, but now like after the acquisition, it's down to around like 3.5%. Yeah, so moving forward, like due to the Red Sea tension, like other like geopolitical tension, shipping costs and container costs actually increase, and they also observe like prolonged timing. So for the time and temperature sensitive cargoes, they'll choose the air transportation instead. Yeah, so they do say like picking up in demand for the air cargoes. And also like they are partnering with the some logistic partner like Cainiao in Europe to handle their European business. And sets do observe like increasing demand from the e-commerce sector. And they also like have another factory in Thailand to focus on the food solution. So they're now shifting its focus to like non-aviation food business. Yeah, that's all for sets. I have another one for ISA. So is ISA, sorry, let me find it. Yeah, so the question was asking if ISA's target price was is 7.8 or 7 point something. Sorry, I can't find the question, but our call for SIA is a reduced call with target price of $5.9. So we have, yeah, it's a reduced call for the company. Because like our outlook for SIA is pretty muted due to the decreasing yield as a result of the very intense competition in the airline industry. And also limited growth potential for the capacity since like their load factor is already at the record high. And the capacity already reached pre-COVID level in fourth quarter 24. And yeah, and we just feel like there's fitting recovery tailwind to support further growth. The only region that is like not back to pre-COVID level is China. And SIA hasn't obtained like all of the regulatory approval from the government to like restore all of the routes, yeah, such as Chengdu. But they recently announced like Beijing has been approved by the authority. Yeah, so they are seeing like Chinese market recovering, especially with the target of resuming 80% of the international flights by the end of FY 2024. And with the 30 days visa-free policy, like more tourism is going to mainland China. And now like for other countries other than Singapore, they have the 144 hours transition like visa-free policy. Yeah, so we expect international flights to recover for mainland China. And also like yield for SIA is compressing in fourth quarter 24. Like and we forecast like FY 24 yield. This will be on par with the fourth quarter 23 level. Yeah, so to keep up with the competition in the industry, SIA frequently launch like the promotional events. Yeah, so our revenue passenger kilometer may decrease. And they also had like a lot of the one-off gains in FY 23. It is approximately 1 billion. So they managed to generate like gains from sales of aircrafts, like tax write-back and interest income. Yeah, so we expect like profits for FY 24 to at least like see decline of around like 1 billion, 1 billion one-off. Yeah, so yeah, that's why like our outlook for SIA is generally muted. And there's a question for OUE rate. What is the cost of debt? OUE rate has the highest among those like investment grade rates, and a negative implication. Also, it has like high gearing close to a limit of 40%. Sooner or later might having a cash call in case of acquisition. Yeah, so cost of debt is around 4.3%. And we expect like the cost of debt to increase by another 30 basis point by the end of 2024. And the negative implication is like mentioned, they will have another year of interest rate headwinds. Yeah, so we expect DPU to drop marginally. By marginally, we believe it's around like 2%. And so possible recovery would be happen in 2025 because they just upgraded to investment grade rating. So it saves like a lot of the a lot of the margins charged by the bank. So pre Fed hikes interest rate, their cost of borrowing is around 4.3%. And the most recent refinancing done by OUE, the cost of debt is around 4.1%. Yeah, so as we generally pressing like one rate cut in FY before 2025, we believe like interest rate will be coming down in 2025. They don't have any refinancing to be done in 2024, and there's a large chunk of debt to deal in 2025. Yeah, so we expect them to refinance in a pretty lower rate. And in terms of acquisition, they do have an acquisition plan, but it's not in the near term because their share price is trading at more than like 56% discount to the net asset value. So it doesn't really make sense for them to have like equity fundraising now. Yeah, I hope it answers your question. And I see. And there's one for CAO. Yeah, so for China Aviation Oil, do you expect them to remain as monopoly supplier at Shanghai Airport in the foreseeable future? Do they expect any new competitor? So according to my knowledge, they will just remain the monopoly in Shanghai Pudong International Airport, and we don't expect any new competitor like new suppliers in the airport, since they own like 33% of the stake in the airport. In the airport. So they do have some like voting power, and they have like pretty good relationship with the rest of the shareholders. So they'll just remain the monopoly. At least like in the near term, like foreseeable future, like you said. And yeah, probably we'll update you if there's anything change. Yeah, thank you. And yeah, that's all for me. I'll hand over for the rest of my colleagues. Thank you.
Yeah, let me take on some. Hi, Paul and team. With the likelihood that interest rates may have peaked, what is the outlook of S-REITs? Yeah, so for S-REITs, right, we are more bullish now because we are in it for the yield play. So that's one. And we believe the S-REITs, the DPU will start to recover as well in 2025 and 2026. So 2026, we are expecting some significant increases in DPU because that's mainly because from the decline in finance cost that's expected during that year from all the interest rates cuts that is coming next year and possibly later this year as well. So yeah, and that also another reason is also because of the fact that it's trading so cheap at about 0.8 times price to NAV because of the recent share price movement. So we think it's starting to look attractive for S-REITs. Yeah, so which REITs would you suggest to buy for Richard? Yeah, we give a presentation of about 4 REITs. First REIT, First REIT, OUE, Cromwell, and CapitaLand Escort Trust. So that is some of our recommendations. And if you want the full list, we have it in our morning note. Yeah, you can take a look at our morning note or our REIT monthly or so. High yield of REITs are mainly driven by the collapse of their stock prices, correct? Yeah, so you're actually right that based on just on the chart that I showed in my presentation, the forward dividend yield is actually higher than the 10-year historical average, but that is also why we are using forward dividend yield instead of the historical dividend yield in our in the presentation and our forecast for dividend yield, because we think that's more representative rather than use the backward data. We use forecasted data to, after accounting for more interest rate headwinds and FX headwinds and such. Yeah, so that's also one reason why I use forward yield. And yeah, but you're right that basically the yield of the REITs recently is driven by the collapse of the share price. What is the outlook and target price on Capital DC Terra REIT? Yeah, so Capital DC right now, we are still waiting for the collection of rents from Quantum Data Center. I think by first half results, if they've still not collected anything, it's almost 1 year of rents that they have not collected. So we will definitely need some updates from them in the first half results. Yeah, keep a lookout because I believe we'll be hosting them for webinar as well, sometime in August. Yeah, so if you're interested, please sign up. But for Capital DC, yeah, the biggest headwind is still that, which is the Guangdong Data Center non-payment. And we have an accumulate rating on Capital DC with a target price of $1.86. So that is just a slight upside from the current share price right now, which is about 180. Yeah, for the Daiwa Logistic Trust REITs, basically because their assets are in Japan, they benefit a lot from the cheap loans, but at the same time, the rents in Japan also, there's no escalation. So the rents are flat and they benefit. So for them, it's hard to see much growth in DPU. Yeah, if you invest in them, you probably just you happy with just collecting the stable DPU. Yeah, and not much rent growth or DPU growth. This this comment on Mapletree industrial weakness is due to logistics segment or US segment. The Mapletree industrial weakness is I would say is attributed more to the US data centers because some of the big tenants, they didn't renew the leases like AT&T. So but recently they managed to find a replacement tenant for one of the data centers. So that will bring back their US data center occupancy to about 90%. But post the FY results, it was around 86%. So that was real weakness there. Yeah, so the US data center side. Yeah, but if you take a look at all the REIT share price, I think a lot of it is just the macro factors where interest rates are the delay in rate cuts, and now we're expecting just one rate cut. From the start of the year, we're expecting 5 or 6. Now it's just one. I think that really affected the REIT's share price performance over the past half a year. Do you prefer Mapletree Logistics or Phasers Logistics? Yeah, so or do you prefer Ascendas or Mapletree Industrial? Yeah, so this I'll need to go through and see more in detail. But just for some of the quick stats, I can do a quick comparison. Just the stats wise, Mapletree Logistics and Phasers Logistics. Yeah, yeah, I can do a proper comparison for you. But it'll take a while. So if you could just email me. Yeah, I could do a better reply for you. Because now, yeah, I need to compile the stats. If you can choose 2 of the 4 weeks presented. Can you share which are the better 2? Yeah, so all these 4 that we presented, they are not apple and apple comparison because first of all, all of them are different subsector. So OUE is more diversified. Cromwell is logistics in Europe and Office Escort is hospitality. OUE also hospitality. First Street is healthcare. So first of all, there are different sectors. They also operate in different geographical regions. But if you're just looking for perhaps stability and yield, one of it I'll say I'll recommend Cromwell for higher yield 10% and perhaps OUE, which gives about 7.8% or 8%, because OUE's assets are like predominantly 90% in Singapore, so the valuations they are mostly stable in Singapore, and so it's backed by the asset valuation as well. So yeah, I'll just name these two REITs. Sorry, the second question disappeared. Can any possible recovery for Manulife and Prime in the view of upcoming interest rate cuts? Yeah, so we believe it will still remain weak until the cuts actually come. So for them, the expectation of interest rate cuts doesn't really benefit their interest, but or rather interest expense, but it might help to have some more investment demand, but the transaction volumes are still weak. The Manulife is trying to divest some of their assets, but the demand or the interest is not very high. The interest now from the US office space mainly are from more private buyers, like high net worth individuals, private funds, and not so much those banks and such. So it's still weak, but once interest rate cuts come in, the REITs will start to benefit, and probably transaction volumes will start to come back faster as well, as loans are easier, as a banks the basically money is cheaper, and the investors will start looking at the US REITs to perhaps look at some assets where they can buy it cheap. Yeah, so there is some value there for Manulife and Prime where they are now trading at like 0.2 times price to NAV. Yeah, so we believe possible recovery might come in 2025, assuming that they can survive this 2024 first. Yeah, and for Prime specifically, it's just the loan that's expiring in July 2020, basically the end of this month. Yeah, I think I'll hand over to my colleagues to answer some. There's still many questions. Thanks.
Ambrish, can you take some?
Thank you. Yes, ma'am. So there was one question from me with respect to Adobe. So is Adobe losing steam, and where does it stand against its main competitors? So overall, we cover Adobe stock, and we have a target price of $480, and with a recommendation of reduced recommendation. So we believe that the growth has already been priced in, and it's a core segment, which is Creative Cloud segment. It generates about 60% of the total revenue. And in the first half of 2024, in the first quarter, so it's net new Creative Cloud annual recurring business, it dropped by about 9% year over year. And this was mainly because of the tough comparisons and the price hikes which were done in 2022. So companies said that it majority hit its customer base last year, and it has started to roll off now. And this was the main reason its net new recurring business for Creative Cloud segment, it dropped by 9%, and it's expected to drop even in the June quarter, but should be come back to normalize in the second half of 2024. And also it faces increasing competition from players like OpenAI's DALL-E, which users can generate images via text-based prompts, and also via Microsoft Bing and Microsoft had also introduced its photo editing tools into its Paint via its Copilot tool. So it does faces competition from these players. So, but there's still a lot of uncertainty as its generative AI has not still contributed to its top line growth, and we need to wait and for any quantitative data from company. And also the revenue growth rate for Adobe, it has remained constant at about 10% over the last 7 or 8 quarters. And we need to see any acceleration in its top line growth. So overall for Adobe, we have a target price of $480 and reduced recommendation. So there was another question with respect to how is Fortinet compare Palo Alto network? Good to explore too. So basically, Fortinet and Palo Alto Network both are cybersecurity companies, and as a result, both the companies they would face a similar macro headwinds. But in terms of business model, Fortinet it manufactures its own chips. It says that it's optimized for its own hardware products and software applications, whereas Palo Alto Network does not manufacture its own chips. And in terms of number of customers, Palo Alto Network, it has 80,000 number of customers, whereas Fortinet, it has about 755,000 number of customers, significantly large. But despite this, Palo Alto Network, it generates higher revenue, annual revenue as compared to Fortinet, and this is, we believe that this is mainly because Palo Alto Network serves a large enterprises, whereas Fortinet, it generates revenues from maybe smaller or small enterprises. And in terms of its revenue growth, Palo Alto, it for this current year, 2024, it expects a revenue growth of about 16% year over year, and as compared to 25% previous year, whereas there is significant slowdown for Fortinet's revenue growth. So this for 2024, it expects a revenue growth of just about a 9% year on year basis. So overall, we believe that Palo Alto Network should be a better recommendation as compared to Fortinet, mainly because of its higher revenue growth rate, and also it has a wide product base as compared to Fortinet. So we don't cover this two stocks at the moment. So yeah, hope that helps. Thank you.
Thanks, Ambrish. I'll just do one or two questions and I hand it back to Zain for technical. Just to add on for the US, I think the prime due date is 18th of July, if I'm not mistaken, the due date for the loans. So that's a very critical date, obviously. The due date for Manulife, or the critical date for Manulife, is June of 2025. Because that is the date where they are committed to under their debt restructuring terms, they committed to sell almost 300 million of assets. So if they don't do that, then they will have to restructure the debt again. And then that could probably hit the share price again. Yeah, but the one to watch is Prime. I think the next few weeks. Yeah, it's a very binary bet, obviously, but I think they have a chance to renew. Yeah. Let me take on the next few questions that I hand to Zain. The Hong Kong China session was postponed. This is our Singapore's our strategy and stock picks. May I know when is the postponed date? Yeah, apologies, they have not given any date. The event was cancelled last Friday because I think the speaker, Louis Wong, fell ill. Of course, it wasn't planned, obviously. That's why apologies for the sudden cancellation. I'm asking, but they're not given a new date yet. So I think they're still working behind the scenes. What's the new date? I guess he's still ill, I presume. Yeah, but do watch for our poems website for the new dates. Then with Trump's lead widening, do you still expect rate cuts? I think we can only assume so, because Trump is always making a point that he wants low interest rates, and they even trying to make some proposals to make the Federal Reserve less independent. That means the the government or the president can have some influences on the Federal Reserve. So I'm not sure if that happens, but I mean, I'm sure there'll be a lot of political pressure on the Fed to cut rates, and that's the best we can see. I mean, the Federal Reserve is supposed to be independent, but I guess supposed to be. So I'm not very sure what this question is. Would like to know if DUC is around 2% the risk-free rate. Sorry, I'm not sure. What the next question also, I'm not particularly sure. As anticipated, the IR coming down looks like more start to jump into property for loan growth will improve. The index do not reflect actual property price trend. Oh, okay, yeah. If you're talking about real estate property, residential, yeah, the sales has been slow, so whether that reflects or not, I'm not sure. I don't really see many people cutting price. I don't really see the developers cutting price. You probably see it when they are hitting their nearer to the 5-year due date, but I don't think there's anything out there right now. Maybe you see it in 2-3 years time. I'm not sure. Yeah. Do you have a year-end target for STI? We don't give STI target because if you mention STI, we actually have to pay STI. I mean, don't ask me why. Not like there's a lot of interest in Singapore market, but FTSE right now will charge us if we talk about STI or we print out. So that's why you will notice we don't really talk about STI. We don't give a target because we actually have to pay a few $1,000s to go and talk about STI. Actually, we should change the index to something else that's free. Yeah. Paul, any comment why Semcom Industries dropping day by day and also Keppel seems the same too? Yeah, for Semcom Industries, the positioning has changed, so don't expect very strong earnings growth. First half of this year, the results coming out will be weak. I think they're probably going to have a hit of 60 million, I think, which they guided, because if you recall, 2 of their power plants are down. And when the power plants are down, they have to actually buy power from third party. We kind of think maybe Keppel will benefit because so they cannot meet the power requirements by the customers. So Semcom Industry, the whole narrative has changed. You have to think of them like they lock in a lot of their contracts, their power purchase contracts long term, and they are more like a long-term dividend play. I think the yield now about 6%. Don't expect very strong growth anymore. They did well because there was a lot of merchant power and they also had a lot of excess cheap gas. So that's no longer happening. So it's more your typical utility stock. You might just move sideways. Yeah. For Keppel, again, if they don't announce any major divestments, the share price going to be impacted because that's what everyone's expecting. So the problem for these two stocks is operationally things are stable, but it also means not much upside for the operations because they locked in back to back. So for Keppel, I think they got like 4 or 5-year power purchase agreements. That means they're not taking they back to back. That means the LNG cost is back to back with the selling price. So there won't be much volatility in the earnings, which is good. I mean, if you have a risk-off move, then this will be the stock. Yeah. I'm asking a big picture for STI index as banks asleep making new high, but there are a mix of STI component stocks that are still at the 3-year low. So STI were to break 3466 last high. What should be the one? Where should one park their fund at? Weak STI counters which have yet to run or wait for correction. Okay. For us, thanks, Matthew, for the question. For us, is just buy anything with a yield. I think, yeah, that's our strategy. Because if you take the view that growth will be slowing down, which is the macro backdrop we have, then it's not going to help the Jardine companies. I don't think China is doing that particularly well. So we think you just have to buy the REITs and the banks, which probably going to be 50-60% of the index. What's the latest poll on the Fed interest rate cut in September? I think it's 30-40% odds of a rate cut. Yeah, I'm using the old one. Let me confirm that, but that's the latest. 30-40%. Any view on Singtel? Yeah, I think we gave our view, so I won't comment. Yeah, apologies for that. We are positive on Singtel. We still think there's 2-pronged. There's divestments and there's also operationally they're performing better because their associate companies are raising prices. Do you think ThaiBev is a good buy at current price and yield? Is it a long hold? Yeah. So we still have a buy call on ThaiBev, but any strong recovery we think will probably going to be the 4th quarter because that's when we think their earnings will turn around stronger. As we showed last week, there is growth. The alcohol consumption is starting to recover, and then we are getting closer to some of the strategic initiatives they are doing. So they will probably this is our speculation. They might maybe distribute in specie, Fraser's property. They might sell a stake in Beer Co. to maybe a Chinese or Japanese brewer. But all this is going to happen only next year. So I don't think this is going to happen this year. So that's why we took it out from our, like we highlighted before, we took it out from our model portfolio. With residential prices in Singapore continue to trend upwards generally, I think it will be sluggish. I think 2,400 for a mass market. I'm not sure how much more you're going to grow. Unless the only thing you can move is unless the authorities relax the ruling, because there isn't really much of a stimulus right now. In the past, you got the stimulus because what happened is that a lot of HDB upgrading, that's the biggest buyer of the homes. And not much, there were some grants, remember, you could get grant as much as 80,000. So that part has kind of slowed down. So unless HDB prices, resale price spike up again, then maybe you can get this huge upgrading cycle, this virtual cycle. But right now, I don't think that's happening. So I think property price, the real estate agents also looking at maybe mid-single digit or low single digit. Yeah. Because right now, no, it's already 2004. Yeah, I think it's also freaking out a lot of developers. I mean, you speak to them, the price of a home right now. Yeah. Okay, I think let me just try. Hi, any reason why venture corp spike up today? Yeah, there isn't any reason. They only announced they're going to announce the results. We don't think they're going to announce any strong results for venture. It's still going to be sluggish. I mean, that's our view. Hopefully we're right. I mean, but that's our view. It's still going to be sluggish. Even if you look at the US contract manufacturers, the only one that's done well is Celestica, and Celestica did well because they are doing AI servers. The rest of the other contract manufacturers are not performing well too. So that's why we're also not optimistic that the results will perform well. Yeah. They might guide a bit better, but we don't think the earnings will be strong for venture. That's our view. Oh, okay, Zain, I think I hand it over to you, yeah, for the TAs.
Okay, thanks, Paul. I'll share my screen now to start on the TA. So first, I'm looking at this, which is Icon Enterprises. I think for now, I'm expecting continued range-bound consolidation because recently price is still testing around the $70 resistance from here. There was a slight pullback, but price you can see is still holding at this horizontal level of $16.30. So likelihood is that we're still kind of expecting some range bound in the near term for this counter. Then next one is on Starbucks Carriers Corporation. So for this, looking at a bit of longer term chart since the end of last year, looks like it might come off this uptrend support line over here. Price did a weak rebound over here recently to test the $25 level again and reverted back. So I think at most it could be doing a range consolidation, could come on to revisit the support here over again, closer to about 23.60 to $24 this area again. Yeah, it might do a bit of range over here, but if it fails to hold the support, you might see an extension of this reversal downwards. Next one is on TFSL. Okay, about TFS Financial Corporation, I think for now, it could be coming a bit lower. Price tested a resistance at 12.65 multiple times plus was able to cross. Then on Friday, it could be breaking down this short-term ascending triangle support over here. So you could see price come down lower towards the support at around $12.30 for a timing as the first support level. The next one will be closer to around $12.10 about there. So we could see maybe a little bit of downside for this if we can't cross back above this support line for TFS. Okay, next one is TA for sets. Okay, for sets, I think still looking good. After this run over here, it looks like there was it consolidated this bullish flag over here. Then on last Wednesday, we had an increase in volume over here again, as well with concurrently this breakout of this flag. So I think for now, still is holding a bit of sideways at this near the recent highs close to 299. I think it's still looking positive overall, as long as price can hold a range, a build up over here at resistance. I think likely is for sets to continue this bullish, this recent bullish run upwards. So if it breaks this key resistance around $3, I think not much resistance next until close to 322 about there, which was the previous opening price from this gap down. Okay, next one is on Oiltech, Pan United, as well as Bank of China. Okay, for Oiltech, I think price is after this gap up over here on a high volume, price pull back afterwards, retesting this ascending triangle resistance around the 46 cents level. So over here today it did a retest of this trend line support as well over here. So I think should be able to hold at this level. Could be doing a bounce at this support level. Then it could do a sideways over here first for a time being, since it's currently doing a retest of the prior resistance for Oiltech. Okay, then for Pan United, I think overall it's just trending up slowly but surely. For now, last Wednesday we had a break of this resistance at 53.5 cents, accompanied with this spike in volume as well. Currently, it looks like another possible consolidation taking place. So I think a likelihood for uptrend to still continue, as long as price continue stays above this 53.5 cents breakout level. I think it's still good for price to trend up over the near term for PanU. Next up for Bank of China. Bank of China, I think for now, it looks like it's doing a range consolidation since a retest of the highs around 370 recently, then price pullback, continue to do a bit of a range over here. So I think nothing, in general, nothing much for now. Likelihood is still going to be quite sideways. Key support would be around one level at around 346. The next one is closer to about 340 about there. Then for now, there's some resistance at around 362. Next one is on ARM. Okay, for ARM, I think it's still looking quite good. Price ran up. Then recently did a bit of a consolidation. And over here on Friday, we had this gap up opening above this recent high of 171, accompanied with volume as well. And actually managed to close above this high at 177. So it is a new high it's a new record close for ARM. So I think with that, it's likely to build on this momentum upwards in the near term, to continue trending higher. Okay, for AMD, I think it's looking positive as well. It did a pullback over here in this downtrend channel. Also, there's a bit of this range going on between 154 about 100 to about 166. On Friday, there was a break of the resistance over here. So I think for now, it looks like a retest of this highs at 174. But if price is able to hold a higher low over here, I think likelihood is that it could break out this 174 and trend upwards to find the higher resistances at about 183 to 187 next. If you can build on these recent breakout over here for AMD. Okay, next one is on TSM. Okay, for TSM, recently also price did a rebound, breaking of this range over here on Thursday, above 176. So currently it's doing a retest of the highs at close to 185 for now. So for over here, we might see some, there could be some slight pullback if there's a resistance holds over here. But I think overall still looking, if you look at the longer term picture, it's still trending up well. So I think yeah, it should be able to break up this resistance soon. Yeah. The next one is on Qualcomm. Okay, for Qualcomm, price for now, I think might still be facing some near-term resistance. There some rebound from this level at 195 over here. Currently back to retest this breakdown over here. A strong support level previously around 205 to about 209 area. So as well as this gap. So over here, I think price might face some resistance if it does a retest of this area. It could do some sideways, but I think shouldn't drop too much in the near term because there's also with this breakout this resistance over here at 203. So likelihood is that it will be quite range bound, I guess, for Qualcomm in the near term. Next one is on applied materials. Okay, for applied materials, I think it's looking better recently. So it did a range over here. Then on last Tuesday, there was a break above or closing break above this $238 resistance. So with that, I think price should be able to go up higher to retest this recent highs at 249. Yeah, then you could see some sideways afterwards again for AMAT. Next one is on NVIDIA. Okay, for NVIDIA, I think for the time being, it's still still some range bound consolidation going on. We can still see some resistance at 128 on Friday over here. The next resistance level upwards will be around 131. So for now, I think probably still some consolidation. You could revisit some short-term support at about 123 or there. Yeah, some sideways first for NVIDIA. Next one is on Apple. So Apple, I think is still continuing on its this strong momentum. So since the break of this downtrend, this downwards resistance line, and then managed to break above the high, this recent high 220. So continuing on the momentum, I think with that, likely to still see some trend continuation going on in the near term. If you use this range consolidation over here between 207 to 220, that's about $13 price range. So projected target in the near term could be around 233 if we project onto this level at 220. The next one is on Tesla. Okay, Tesla, I think interesting because when you look at the very big picture, there was this very key downwards resistance line formed in November 2021. Price has been facing resistance along it. And recently with this sharp increase in price, there was a breakout above it. So likelihood is that could still go higher. Price managed to clear this $247 resistance and close above it on Friday with a hammer. So with that, I think short-term wise, price could still go higher, at least maybe to retest about 265 level over here, which was the highest in December of last year. Yeah, then afterwards, there could be some pause in the rally with some consolidation. So that's my take on Tesla. Okay, then next one, there's also a TA question on Comfort Delgro. Okay, for Comfort, I think for now it's likely to be some sideways consolidation. So since price showed some weakness since breaking down below this 139 level over here, this range consolidation, it also broke below this uptrend channel support over here at 136. Price has been doing some sideways. Near term wise, this support at 131 is still holding. So I think probably some sideways between these current levels at 132 to about 137 for the time being. Okay, next one is on Aztec. Okay, for Aztec, I think there's likelihood to break above this resistance at $1.01 also. Price looks like in forming this come and handle formation, recently about the resistance at 99 cents, doing a retest of the highs over here at $1.01. So with that, I think as long as price can stay above this 99 cents resistance, I think near term wise we should still see price go above this $1.01 resistance. Next level to look out for will be the area between $1.05 to about $1.07 area, which was a resistance back then in July 2021. Yeah, so that's for Aztec. Okay, I think it's about one. So sorry, there's still a lot of TA questions. I am unable to answer in view of time. Feel free to post them in our P3 TA group, and I'll take it from there. I'll pass back the time to my colleagues if there are any more questions to answer. Thanks.
Thanks. Yeah. Okay, we tried to answer some questions. I tried to type in some of the Q&A. So thanks everyone for your time. If you have questions again, do just go to the P3 community. Then at least they also gives us time to try to think before we give you the right answer, and at least do some double fact check. Yeah, but anyway, with that, thanks everyone for your time. Hope it was useful for you, and wish everyone to have a very good week ahead, and hope to see you again next week. And thank you everybody, and have a good day. Thank you.